Hey, welcome to another episode of the Mortgage Minute. My name is Jeff Harrison, and this week on the Mortgage Minute with Art Alvarez, we're looking forward to seeing what is happening. You know, the Fed's been meeting, things have been happening, rates go up, rates go down. What does that all mean to you? Let's bring Art in and let's talk about that. Art, we're having a little technical difficulty. I apologize.
I can see that, Jeff, but
what is going on here? I don't know. It's I guess I better get those technicians back out here and see if they clipped a wire they shouldn't have, because all of a sudden I had some funny things happening. So what's going on in the world of mortgages and the Fed and all that kind of stuff? I know you're going to dive into a lot of this stuff, but give us that 30,000 foot overview. Is it getting better, worse, staying the same? What's going on?
Well, I think actually, relatively good news. I think we're certainly off that little bit of a scare we had in bond yields about a week or so ago. So we've come down off of that. Some inflation numbers came out today, slightly better than expected. Got some more coming out tomorrow. And the news media is talking about, we're back to a 7% mortgage level. Not quite true. Certainly not, at least with us. So we'll get into that in more detail.
Fantastic. Well, let's turn it over to you. I'm going to remind everybody that if you're joining us live or afterwards, please make sure to put your comments in the comment section, and I'll be more than happy to give them over to Art. Art will answer them if he's live, and then he'll follow up with you after a recorded version. So, Art, over to you.
Okay. Thanks, Jeff. Hello, everyone. Welcome to this week's Mortgage Minute. I'm Art Alvarez at MortgageWorks, where we do have the answers, and they're on the house. So I want to get into, as we always do at the beginning of the program, let's talk a little bit about where mortgage rates are at. Jeff just pulled up our rate grid off our website. So as I said earlier, it was interesting today. I've noticed both in listening to business news, watching it early in the morning, as well as reading up on what's going on. A lot to talk about. We're back to a 7% mortgage rate. Not quite true, at least not for most conforming loans, including FHA, VA. We're still in the sixes. So if you're encountering any lender telling you that conforming loans are 7% or more, you might want to check with us, because we're going to have a better deal for you. So anyway, on our website, you can see the rate grid. And of course, at the bottom of that rate grid, you can click on About Mortgage Rates and get a lot more detail about how mortgage rates are determined from day to day, as well as within the day. So what is going on with the bond market this week? Well, I think it's been relatively positive, actually. Here's a chart of the 10-year bond yield, my favorite benchmark that I mention all the time, for all of you to look at as a way to get a general idea where mortgage rates are headed from week to week and even day to day. And as you can see here, going back to last Friday, the 10-year bond yield kind of scared the markets a little bit. It actually exceeded 4.20. Primary reason for that was the Fitch downgrade of U.S. Treasury debt from a AAA rating to a AA plus. So that shook up the markets. But since then, the bond yields have been settling down. We do have a little bit of an uptick today, which was actually a midday situation, having to do with some inflation numbers, which we'll talk about here in a second. And in fact, that's what this week is all about in terms of bond yields and how they've been affected by the markets. It's all about the inflation data. And so this week, the primary economic data points that have been released or are going to be released includes CPI, initial claims for unemployment, and the PPI. So as I said, with CPI and PPI, then really this week is all about inflation data. So the first number to come out was this morning, the CPI, also known as Consumer Price Index. And again, as Jeff just pointed out here on the chart here, yield has trended down from 4.20. You saw on that chart, we're more like 4.08 right now. So today the CPI comes out. Again, Consumer Price Index. That's sort of the retail inflation number. And it was forecast to actually be a little bit of an uptick today, 3.3 over 3% in June. Well, it turns out it came in slightly below that, 3.2, which actually the markets reacted favorably to that, at least early in the morning. The stock market, jumped up, had a rally going. And actually, the bond yields dropped a little bit. We were actually at one point earlier this morning at 3.98. So this 3.2 number, though a slight increase from June, was lower than expected, and the markets reacted favorably to that. Now, the primary driver of the current inflation number, at least for July, was shelter costs. No surprise there. Of course, mortgage rates being where they're at. But more importantly, rents are way up. Lots of news about how rents are just getting really sky high in a lot of markets. So that's having a big impact on that CPI and is probably responsible for that little bit of an uptick over the month of June. Now, the core CPI, which is where you exclude shelter and energy, that was actually at 0.2%, also within line of expectation. So again, overall good news. Now, the initial job claims actually jumped up. 231,000 was forecast, which is an increase slightly over June of 227, the actual 227 in June. Well, it turns out today the initial claims jumped to 248,000. So that's, again, another sign of maybe that job market's not as strong as been indicating. And then, in fact, maybe with a little bit of an uptick in initial jobless claims, maybe that's a sign that the job market might be weakening just a tad. So then again, tomorrow is the next big number. That's going to be the producer price index. That's, again, what they would refer to as wholesale inflation. This is inflation at a producer level, not at a consumer level. The forecast for that number for tomorrow is 0.2. Again, a slight increase over June of 0.1. If the PPI does come in at 0.2 or lower, then you can expect those markets, both the stock market and the bond market, probably would react favorably. And with bond yields, we could see some improvement in bond yields tomorrow. I haven't been able to read get a hold of current news as it's happening the last couple hours to see why the 10-year bond yield has jumped up a little bit from about 4.0, 4.1 early this morning up to the current 3.8. So we'll have to look into that a little bit later. The overall point here, though, is I call this essentially positive, or at least relatively good news. Mortgage yields are hanging in there. We're not at a 7% market for many of the conforming loan type programs, Fannie Mae, Freddie Mac, FHA, VA. If you've got a decent credit score, you can still get rates under 7% for that mortgage. And if you are talking to a lender and getting quotes higher than that, you really should check with us. I think you're going to find we can offer you a better deal. So that's where mortgage rates are at right now. I think, again, relatively good news. Rates aren't shooting up dramatically. And so I think we really have hit a kind of a resistance point at that 4% plus level on the 10-year bond yield. So let's keep our fingers crossed that things remain relatively stable and we don't have any shocks to the upside. With that, I want to kind of continue on to a different subject, one that I was talking about at last week's program, which was mortgage insurance. And of course, last week I was talking about PMI, and of course, referring to that as possibly a lot of folks look at PMI like it's the devil. This week, I want to talk about FHA mortgage insurance. FHA mortgage insurance, in my opinion, is well worth the cost. However, the cost is often viewed by many prospective borrowers or even people who have FHA loans as expensive. That mortgage insurance on an FHA loan is expensive. So I want to get into that in a little bit more detail because it's a little more complex than private mortgage insurance on conforming conventional loans. Now, first of all, just as a reminder, kind of a history lesson, FHA mortgage insurance was a brilliant concept that was actually created in the 30s. This was during the Roosevelt administration. And of course, at that time, if you wanted to buy a home, the down payment had to be substantial, usually 20, 30, 50% down, and very short loan terms, typically maybe 5 years, could possibly get to 10. But those type of terms made it very difficult to finance the purchase of a home. So it was in the 1930s, as part of the New Deal to get the country out of the Depression, the concept of mortgage insurance was developed. And the idea is that a mortgage insurance would be provided to lenders, and it would protect them in case of default by the borrower. And what this did is it induced lenders to accept much lower down payment amounts. Of course, FHA, as you may know, is as little as 3.5% down. And it also allowed lenders to thereby increase the loan term from much longer than 5 or 10 years out to 30 years. Well, the combination of that much lower down payment and the much longer repayment term provided much more affordable financing terms for people to buy a home, again, back in the 30s. And that's what helped spur some a lot of the home construction that would occur in the next couple of decades that allowed the housing stock to be grown substantially. So it's a great concept. It's again been around for almost 100 years when you think about it. And this is why, in my opinion, FHA is one of, if not the best mortgage program ever developed in this country. So again, that's the background to it. How does the cost actually get assessed to the borrower? And by the way, it seems odd, even though this is insurance for the benefit of the lender, the benefit to the borrower is, again, it allows you to get the loan at much more favorable terms than used to be the case. And the idea is when you're putting less down, there is a greater risk as a borrower that you may default on the loan. And with this FHA mortgage insurance, if that were to occur, the lender can submit a claim to HUD. That's the Department of Housing and Urban Development, which administers the FHA program, the Federal Housing Administration. So the lender can submit a claim to HUD to be reimbursed for their loss from having to foreclose on that borrower. So that's the underlying reason for the FHA mortgage insurance. Now, the mortgage insurance actually, in terms of cost and types, has two components on an FHA loan. The first one is what we call the upfront MIP, and you can see it there, UFMIP. The upfront MIP, that's upfront mortgage insurance premium, it's 1.75% of the loan amount, so just under 2% of the loan amount. Now, that's a pretty big number with most, FHA mortgage transactions. While it can be paid in cash, that almost never happens just by nature of the fact that it's a pretty large number. So FHA, realizing that, allows the borrower to finance that lump sum premium into your loan amount. So you take your purchase price, put your 3.5% down, you're going to have a resulting base loan amount. You'll calculate the upfront MIP at 1.75% of that base loan amount, and then take the result and add it to your base loan amount to get what we call adjusted loan amount. And the idea is that upfront premium is paid for through your monthly principal and interest payment that is based on that adjusted loan amount that includes the upfront mortgage insurance premium. Now, in terms of dollars and cents, what does that mean to the borrower? Well, for example, on a sample of, say, a $500,000 purchase using an FHA loan with a 3.5% down payment, this 1.75% upfront premium that's financed into your loan and paid back through your monthly payments, it adds $53 to that monthly payment on a $500,000 purchase. So keep that number in mind as we now go into the second component of FHA mortgage insurance. And that second component is there is an annual mortgage insurance premium, also known as an annual MIP. And that is going to range from, for a 30-year fixed rate loan, somewhere between 0.50 and 0.55% of the loan amount, depending on your down payment amount. In other words, if you're putting the minimum down payment of 3.5%, the annual premium is going to be 0.55%. If you're going to put more than 3.5% down, then that would allow the annual premium to drop to 0.50, also of the loan amount. And then the idea is that annual premium is paid monthly as part of your impounded mortgage payment to the lender. So again, that's paid monthly as part of your impounded payment to the lender. Now, using the 0.55% premium amount, using based on a 3.5% down payment on a $500,000 purchase loan, that adds $225 a month for the annual MIP, the annual mortgage insurance premium. So then take the two together. What's the cost to your principal and interest for the upfront premium? $53 a month. What's the cost for the annual MIP premium? $225 a month. Add those together, you're looking at about $278 a month in total for the cost of that FHA mortgage insurance. Sounds expensive? Yes and no. Why? Well, consider this. For any borrower who is looking to purchase a home with a minimum down payment and is looking at a conventional loan instead of FHA, for example, a conventional loan, if you're a first-time home buyer, you can actually get the loan with a 3% down payment. Or if you're not a first-time home buyer, you can get the loan with a 5% down payment. Well, guess what? If your credit score, your qualifying credit score, is about 710 or less, the mortgage insurance, the PMI on that conventional conforming loan, is going to cost you more per month than this FHA mortgage insurance, using this example of $500,000 that I just did. So the point is, if you're a borrower and you're looking at buying a home with a minimum down payment somewhere between 3 and 5% down, if your credit score, your qualifying credit score, has been determined to be around 710 or less, you are likely going to be much better off going with an FHA loan rather than a conventional conforming loan, in part because the mortgage insurance premium in total, both the upfront portion and the annual portion, is going to be less cost to you than the conventional PMI, private mortgage insurance coverage, that would be placed on that conventional loan with a 3 to 5% down payment. Why is that? Well, conventional loans, I've mentioned this before, do have much more severe what we call price adjustment factors or loan level price adjustments for lower credit scores. And what that does is it not only raises the rate offered to the borrower, it also increases the PMI premiums. Lower credit scores on conventional loans are going to drive up the PMI premium that's going to be associated with that loan because of the less than 20% down payment. So again, keep that in mind. FHA, if you're 710 or less, that's likely going to be a better program for you. You should at least check it out. Feel free to contact me. I'd love to give you a worksheet and show you the benefits of FHA, because in a lot of cases, it's going to be, in fact, I would argue in most cases, if you're below that score, you're going to be better off in terms of overall loan terms for your loan transaction. So keep that in mind. Now, next week, we're going to talk about how to get rid of mortgage insurance, both on the PMI side, which I did hint at last week is cancelable, and then on the FHA side, what is involved in getting rid of that FHA mortgage insurance. So we're going to talk about that, both PMI and the FHA mortgage insurance, how to get rid of those. We'll talk about that next week. So now I want to move to a different subject, and this one I'm being a little bit, I guess, humorous about it in terms of what I'm calling this next segment. But as you can see there on the slide, I call it "Lovin' Little Loans." And so what do I mean by that? Well, in all my years of being in this business, one of the things I've noticed is that folks who need little loan amounts, small loan balances, I think to some degree are underserved. Historically, small loans could be relatively scarce and can cost more. Well, why is that? Well, in a lot of cases, even though the minimum loan amount that can be made for a Fannie Mae or Freddie Mac loan or an FHA and VA is actually quite low, well below 100,000. A lot of lenders didn't want to do that. So they would have, again, what we would call overlays, where they might establish a minimum loan amount that particular lender wants to offer that may be higher than what could actually be delivered to Fannie Mae or Freddie Mac, or that can be done with an FHA or VA type of a loan. So in part, that would create sort of a reduction in the number of lenders who can even serve that part of the market. Plus the fact a lot of lenders, and this actually even goes back to the agencies themselves, Fannie Mae and Freddie Mac, some of the price adjustment factors or loan level price adjustment would actually be kicked up for lower loan amounts, particularly if you got below 250 or below 200, and really pretty significant price edge if you get below 150 or 100 or 75. They could be very substantial. And so you'd end up with a case where even though a borrower may be getting a relatively small loan for the value of their home, they end up paying a higher rate than somebody who's getting a much larger loan amount simply because they happen to have a need for a very small loan balance, and that lender doesn't really want to make that loan. Now, with that background, what I want to let everybody know is that has changed. The industry, and in particular, the agencies, the government-sponsored enterprises, Fannie Mae, Freddie Mac, there is now a push for more support for small loan balances. That's going on right now. Most all the lenders that we deliver loans to are now offering much better pricing if you're in need of a very small loan balance. And what would we define as a small loan balance? Well, again, it kind of starts at about 250 or less, and then there's another kind of threshold at 200 or less, and then where you can really get a great enhancement on your pricing terms for a mortgage is if you're below 150. So I list all three of these, what I call balance buckets. And as you go progressively down on these buckets, you're going to see some pretty aggressive financing, or pretty aggressive pricing on the loans that are available. And in fact, if you really get low, like under 150, you can actually see on a 30-year fixed rate mortgage an interest rate available to you that could be as much as 3/8 to 0.5% below what it would be if you had a more quote unquote normal loan balance of, say, 350, 400, 500,000. So, and the reason for that is the agencies have waived almost all of the loan level price adjustments or price adds to allow those borrowers who need these smaller loan balances a much better deal. Now, this, by the way, it extends to a couple of what we call affordable loan programs that Fannie Mae and Freddie Mac have been offering for quite some time. These are called the Home Ready and Home Possible programs. Now, these are directly geared toward borrowers who are low to moderate income. And in fact, to be eligible, you have to have qualifying income within a specified limit based on your family size. But with these programs as well, which do tend to attract smaller loan balances by definition of them being for first-time home buyers, these programs also offer the same waiver of most price adds. So the pricing on them in terms of rate is very good. Plus, with these Home Ready and Home Possible programs, if you're eligible based on your income amount, actually give you reduced mortgage insurance costs, reduced PMI costs. So that's something to keep in mind as well. So if you've got a small loan balance that you're in need of, it's a great opportunity right now. And what kind of borrowers do these smaller loan amounts serve? Well, for example, senior homeowners or buyers who may want or need a small loan. They don't want a reverse mortgage. They do want a small first mortgage. They may need that. That's a great borrower who in the past has had to suffer with higher rates simply because they wanted a small loan. Another type of a buyer is somebody looking for the more affordably priced, lower priced condos, for example. Again, those borrowers in the past, those buyers would oftentimes be penalized, if you will, by getting higher rates offered to them simply because they wanted a very small loan amount. And then, of course, another product type in terms of homes where small loan balances now will have a better opportunity for better pricing is manufactured homes. Many manufactured home transactions involve relatively small loan amounts. And so that type of buyer now will have the ability to get much better deals on their rate than was happening before. And at MortgageWorks, we've always, we love little loans, as Jeff just pulled up here. Always have. I've always felt like that's a bit of an underserved market. I think anybody who needs a $100,000 loan should get just as much of attention and respect and fair dealing as somebody who's getting $1 million loan. Frankly, the file of paper that we're going to end up with when the deal's done is going to look about the same anyway. It doesn't really cost us more to process $1 million loan as a $100,000 loan. So we're happy to do each. And we want you to know that if you need a small loan, we love you as the borrower. We love your little loan amount, and we would be happy to assist you with that. So just keep that in mind. Little loans are at play right now. So if you need one, give me a call. I'll be happy to give you some numbers. And with that, we'll go on to our next subject, which is I want to actually go ahead and talk about last week's closing question. And in that regard, here's the question. The Fed raised interest rates by 0.25% on July 26, 2023. That means mortgage rates increased by 0.25% as well, correct? Well, you may be surprised that the answer is no, not correct. Well, why is that? Well, it starts with the continued, I think, oversimplification of interest rate news in general, where the suggestion is, by the way I frame the question, that the Fed raises and lowers interest rates with an S. Well, not exactly. When we hear about the Fed every month or every couple of months and having a meeting and raising rates, what are they actually adjusting? Well, they're raising a specific rate, the Fed funds rate. That is what they're adjusting from time to time. So they're not just with a wand waving or raising or lowering all rates that are out there. They are adjusting only the Fed funds rate. The Fed funds rate is a specific rate that is charged by, that is a rate that is charged for borrowing among member banks of the Federal Reserve System. So that rate does not, for example, correlate at all to a fixed rate mortgage. It does correlate, though, directly to HELOCs and credit cards. Now, why is that? Well, HELOCs and credit cards, unlike a fixed rate mortgage, are essentially variable rate loans, and they're tied to an index, most typically the prime index, also known as the weekly average prime index. That's essentially the rate that banks charge their prime customers. Well, the prime rate does directly correlate to the Fed funds rate. So when you hear the prime rate or the Fed funds rate has gone up a quarter, that means the prime rate's gone up by the same amount. So that means your HELOC has gone up by the same amount, or your credit cards have gone up by the same amount. So as a consequence, you want to understand that that is how it really works. And in fact, with this last increase in the Fed funds rate on July 26, the initial reaction to the bond market, or in the bond market, the 10-year bond yield, for example, it actually dropped after the announcement. It went from about 4% plus or minus to about 3.96. So that's sort of counterintuitive. Most every time the Fed raises the Fed funds rate and it hits the news, I'll often get calls about, oh, did mortgage rates just go up another 0.25%? No. Again, the initial reaction after the last Fed funds increase on July 26 is bond yields, and therefore mortgage pricing actually initially slightly got a little bit better. So just keep that in mind. In fact, what that means is when the Fed does make their announcement of changes in the Fed funds rate, if it's as expected, in most cases, the bond market does not react, adversely to that. We don't see bond yields shooting up and therefore mortgage rates shooting up. It's all about expectations. So what spooks the markets more than anything is something that's released that's not expected. That's generally going to have a bigger impact. So, just keep that in mind that, now after the initial Fed funds rate increase on the 26th and that bond yield dropping, well, the next day it did shoot back up, but it really was for different reasons, different data points. So remember that in terms of mortgage rates and bond yields, they can change from day to day and intraday based on different data points that are released. And so it's not really the case where you can just say, well, because the Fed raised the Fed funds rate 0.25%, that's why mortgage rates are higher now. There could be a lot of other reasons. And last week, of course, it was the Fitch downgrade, which really shot up the bond yields up to as high as 4.20. But since then, again, we've settled back down. So just understand that that's really how mortgage rates are determined. And of course, as I mentioned, the 10-year bond yield is your best barometer, I should say, to track where the direction of mortgage rates are going. And in fact, in that regard, for those of you who are interested, keep an eye on the 10-year bond yield on Friday, tomorrow, and how it reacts to that PPI, that producer price index being released. That'll give you a good real-life example of how bond yields and therefore mortgage pricing is going to be affected by the release of a pretty important data point. With that, let's go ahead and go to our closing question for next week. And with this one, I've got a little bit of a different subject matter. Let me go ahead and read it to you. It is about FHA loans, and it's a question that we do encounter from time to time, actually more often than you would think. Here's the question. Is there a minimum distance a borrower must relocate before a second FHA loan can be obtained? Again, is there a minimum distance a borrower must relocate before a second FHA loan can be obtained? It's going to be an interesting answer. So tune in next week where I'll provide you the answer, and it will be on the house. Jeff, back to you.
That's an interesting point. How far can I live away before I can get a second FHA loan? So a second home, right? Or it would have to be a second home?
Well, yeah, and without
I don't want to.
Without committing a spoiler alert here, it gets into issues about second homes as it relates to FHA, and and what the overall mission of the FHA program really is all about. So that's really what this question gets into, and again, we'll get into that detail next week. That's why I said it's a pretty interesting question, and again, it's one we run into more often than you think.
Well, I also want to mention the piece about the Fed funds rate and when it goes up and down. And I've had that I've been guilty of thinking the same thing until being more involved with what we're doing here and now understanding, hey, the two may not even have any correlation. They one does one thing, and like you said, it goes up, and actually the bond goes down, and really that's what's tying up the mortgage rate. But I thought it was interesting that you said, hey, with the exception of HELOCs and credit cards, and that is tied to the Fed funds rate.
Well, yeah, what's interesting, see, it's all about the markets generally are going to, in advance, make a bet on what the Fed's going to do before each meeting. And so a lot of cases you hear about how the markets have already priced in what is expected, what the expected action of the Fed is going to be, that they've already priced it into the market, both on the stock side and the bond market side. And so the idea is, like on the bond market side, I routinely see, as you're approaching a Fed meeting where there's an anticipated increase in the Fed funds rate to occur, you'll often see the bond yields kind of creeping up. And then, right up to the meeting schedule. And then once the meetings conclude and they release their announcement as to what the decision is, if it's as expected, then the bond markets generally stabilize and will oftentimes trend lower, better, because the announcement turned out to be what they had projected and already priced in. And that's going to be happening with the next meeting with today's inflation numbers, and we'll see what tomorrow's PPI does. But with even today's inflation numbers, now the percentage, the market's forecast is now rated at a 90% chance that the Fed may pause at their next meeting and not raise the Fed funds rate. So, if that 90% holds as we're approaching the meeting, and if that does end up happening, then that's going to be good for the markets.
Yeah, no kidding. I tell you what, and you've discussed this before about trying to time the market and waiting till the rate may go down. And I know you've given plenty of notification on many different instances about, hey, take advantage of what you have now. If you can find the home you're looking for at the price, because it could go higher. If the rates go down, I guarantee you the price of a home, I shouldn't say it, I can't guarantee it, but I can anticipate the cost of homes are going to go up and more. And any savings you would have experienced, you gave away in the price for the house going up. But you had something. I'll let you talk about this for a second, then I'll let you go. Is using that buy down process. I mean, is that still a good play?
Well, it still is, and it's on our rate grid. I mean, even now, again, I was on CNBC this morning. Conforming 30-year loans over 7. Well, not really true. I mean, we can still get your note rates under 7% for conforming loan. And then if you layer into that, a 2-1 or a 3-2-1 buy down, temporary buy down, negotiate that on your offer and get the seller to pay for it. Well, then in reality, you're going to get a first year mortgage rate somewhere around, mid 3s to mid 4s, not mid 6s to 7. In fact, I was just talking to an agent this morning on an FHA offer. And the buyer is very, very payment sensitive. So we talked in detail about the strategy of offering full price, in fact, maybe even offering above full price, but ask for a concession from the seller to pay for a 3-2-1 buy down. Because in the case of an FHA loan in particular, you can still get those in the low 6s. So you get a 3-2-1 buy down on an FHA loan with a note rate of 6.25. Your first year rate's 3.25. Wow. That's almost as good as we saw in the trough, the low point of 20 and 21.
Yeah, so, that's fantastic. Yeah. Well, on the screen, you see information about Art and how to get a hold of him. He is a strategist, and he has, over 40 years in this industry and can help you figure it out. And he talked today about little loans. It started making me think about some ideas I should have about, as it's so hot here in the desert, it's like, boy, should I buy a little mobile home and put it up on the mountain? I don't know. So, get a hold of Art. His information on the screen at 760-883-5700 is his office. You can always contact Art unless he's in the middle of his backswing. Please don't call his cell phone number, but that's 714-612-9035. I've heard he puts it on vibrate when it's his turn to hit. So you can always go to his website, mwloan.com. And then, of course, you can contact Art directly at art@nwloan.com. Art, any last words before we let you go?
I'll keep working on that backswing, Joe.
All right, I'll turn it over to you. Have a safe trip. A safe weekend. Remember, folks, if you have a question and you want answers, it's on the house. But more importantly, put it in the comments, whether you're on YouTube or Facebook, and Art will get back in touch with you. And if you need answers right away, remember, you're probably going to catch him when it's not his turn, and he'll answer the phone right away. Call him on his cell.
Thanks, Jeff. Thank you, everyone. Thank you for watching and listening. Remember, Art Alvarez at MortgageWorks, where we do have the answers, and they're on the house. Take care. Have a good weekend.